So, as always, before we get into it, give this video a big thumbs up. So, I have a question for you. What is the right time to sell a stock? This is a question that has had many investors bewildered over the years. However, to answer this question, you must first ask yourself, are you an investor or a speculator? If you aren't sure, let me tell you the difference between the two. A speculator is a person who is only concerned with one thing: the change in the price of a stock. Speculators are people who like to place bets on which way a stock will likely move. If the stock does not respond the way they anticipate, they have no other option but to cut their losses and move on. This is one of the reasons why you will observe that speculators have a very short time horizon. The most extreme form of speculation is done by a day trader who buys and sells stocks multiple times a day. An investor, on the other hand, is someone who buys a stock not because it has recently shown positive price signals. Instead, he or she likes the underlying business that the company is operating in. The investor does thorough research and analysis of the industry and its competitors. The investor feels confident of the management expertise of the company and foresees good future growth potential. Therefore, an investor usually has a long-term investment horizon and is not too concerned with the temporary price dips and fluctuations that his investment might experience. For example, an investor who bought 1,000 shares of Amazon stock in January 2000, when it was trading at $63, would not be too stressed when it crashed to $15 a few months later. The Amazon investor who saw the long-term potential of the company and stuck with his investment would be over $300,000 richer today. In today's episode, we'll be looking into the fundamental investor instead of the short-term market speculator. Even though Warren Buffett describes an ideal investment as one that you can hold on to forever, this is not often that realistic. Sometimes, selling off the stock can be the best or the only option for you. However, you do not want to find yourself in a situation where you sold off a stock too early or too late. Just like there are rules for buying stock, you also need to follow some rules for selling your stock at the right time and at the right value. So, below are a few conditions in which selling a stock makes the most sense. Number 1, the fundamentals have changed for the business. Sometimes things don't work out as well as you anticipate. Yes, you did your homework, and all research and analysis indicated it as a good company to invest in. But many unforeseen things can happen that will make an investment lose its charm and value. Maybe there was a change in management and a change in vision. Or maybe there were changes in the regulatory landscape, which slowed down the growth of the company. And there could be 1,000 other reasons like this. Maybe you invested in an industry which has suddenly gotten outdated due to some new disruptive technology introduced in the market. For instance, there's a chance that in the next 50 years or so, the gasoline automobile industry will get completely outdated as electric vehicles become more widely used and become a permanent household feature. Maybe the gasoline cars will instead become more of a collector's item, while electric cars become the go-to vehicle for daily usage. Several indicators can tip you off regarding the decline of a company's performance. Usually the price of the stock starts to head south, and you get the feeling that it's not going to stop falling anytime soon. Abnormal price movement is usually one of the earliest signs of something bad happening to a company. This is later validated once a company's annual information is made available, and you see that the financials have taken a hit. Financial ratios analysis can help you determine the profitability and financial position of your company. Some of the ratios that can be helpful in your analysis are dividend yield, price to earnings, earnings per share, dividend payout, debt to equity, current ratio, etc. If you observe that the fundamentals of your company have weakened, that is a good enough indicator that you should think of selling your stock. The number 2 is when companies eliminate or reduce their dividends. Although this is in some ways connected to the first condition that I just told you about, I wanted to highlight it separately because it's that important. When a company suddenly announced that they're going to pay less dividends this quarter or not going to pay you any dividend at all, this should be a red flag to investigate the financial performance of the company. Usually, a company will do this if they have consistently not performed well in the past few quarters. And this is a good time to reevaluate your investment and maybe sell it off. You must, however, be completely thorough with your research as to why the company has suddenly stopped paying dividends. Maybe the company is just looking to expand its production facilities and will be reinvesting the dividends. Or maybe it's going to invest it in research and development. You don't really have anything to worry about if it's done for those reasons. That's because it will add to the long-term value of the company. And it also shows that the management is eyeing growth opportunities. If you're the sort of investor who wants consistent dividend income, then maybe the time has come to sell it off anyway and buy a stock with more guaranteed income. The third reason for selling your stock is when the company reaches its intrinsic value. Since you're a fundamental and a value investor, this means that you have probably bought the stock at a discount to its intrinsic value. This is the number one rule of value investing. Only invest in something which is priced below what it is actually worth in the market. It will guarantee you a safety margin and an adequate return. So if you've bought a stock at a discounted price, then the right time for you to sell it is when it reaches its intrinsic value. Exiting such an investment is always tricky. You might feel that holding on to that stock can be better for you. And to be honest, it is a judgment call. You could be right, and the company continues to do well, and reinvests your capital at a higher rate of return. You can also be fatally wrong, and the company makes a few wrong decisions and finds itself in a financial mess. I would recommend you exit the stock at its intrinsic value, or a bit higher than it. For instance, if you purchased a stock worth $100 at a discounted price of $50, and in a year it returns to the $100 value, you should consider selling it. That's because you've already made a 100% return on it. There's no need to be greedy. So, take a look at other opportunities which are selling at a discount at the time, and invest in those. The fourth circumstance in which selling stock can be justified is when you have a better opportunity. Under normal circumstances, I would not advise you to rebalance your portfolio so often. However, if you're presented with an opportunity, which you are very sure of and will make you big money, then maybe selling your stock to invest more into that opportunity can be justified. As fundamental and great as those conditions are, some other circumstances or strategies that you need to be aware of while selling your stocks are: Number 1, avoid or exit stocks that attract a lot of media hype. I've been a victim of this circumstance. A few years ago, one of the stocks in my emerging frontier market portfolio attracted so much attention that even if you left a monkey on the trading floor with only one stock to trade in, he would make you millions. The stock climbed so much that I felt that it would keep on climbing. Little did I know that the stock would crash after a few months. Liquidity would dry up, and I would not be able to exit it in time to avoid the crash. Nevertheless, it was a lesson learned the hard way. Number 2, be mindful of trading too frequently. Rebalancing your portfolio isn't a free endeavor. Obviously, you must pay certain brokerage costs and commissions each time you buy or sell a stock. You might not even realize it, but those could stack up and hurt your invested capital. A few educated and researched trades will beat 100 random speculative trades any day of the week. So choose your investments wisely in the first place. Number 3, don't sell off all your holdings. This strategy is similar to the average buying strategy. Just like value investors would advise you to slowly build up your investment portfolio by averaging the price of your stock, the same advice applies when selling stocks. Don't dump all your profitable stock all at once. You can sell some of it gradually every few weeks or so and reinvest the profits in other opportunities. That way, you will not miss out too much on profit if your stock keeps on rising a few more weeks after reaching its intrinsic value. Also, if the stock falls after that, you will experience the loss on a reduced invested amount, so that will mean minimal loss on your end. Those were some additional circumstances that I wanted you to think about. Timing the sale of a stock is an art, rather than an exact science. It comes with years of investment experience and requires you to control your emotions and your behavior. Most of the investors either sell too quickly or wait until it's way too late. You need to learn the art of selling at the right time. And the right time is usually somewhere along the point where your stock reaches its target price or intrinsic value. Whatever your reason is for selling, I hope it's a good one. Hopefully you found value and you're able to take a few lessons from this video and implement them in your own investment practice as well. So thank you guys so much for watching, and please go ahead and give this video a like, subscribe if you haven't already, and enable notifications by clicking on the bell icon. All of this stuff helps us keep making videos like this one and grow the channel even more. With that said, you guys, have a great day, and I'll see you all in the next one.